How much money do you need to invest in the stock market to retire with inflation adjusted $2 million? In this video, we will talk about a very realistic and achievable investment amount and a savings and investment strategy that will help you achieve your goal of $2 million retirement. I will be specifically talking about inflation adjusted dollar amounts because the value of money decreases with time due to inflation. So I will be removing inflation from our estimates to make sure the purchasing power of your retirement amount is the same as of today. Lastly, $2 million is the right target to aim for because it will allow you to withdraw $8,300 each month from your investment for the next 20 years of your remaining life from the age of retirement. Average life expectancy in United States is about 77 years. So on an average, a person can expect to live another 20 years from the retirement age of 65. My name is Kanak and welcome back to my channel. If you haven't already, then subscribe to my channel for more informative content. So let us get started. I will simplify the calculation in a way that's both simple and easy to understand. First, let us look at the historical returns of S&P 500 over the last 50 years. As you can see on your screen, the annualized returns of S&P 500 index over the last 50 years if the dividends were reinvested is about 10.76%. However, if we remove the average inflation rate of roughly about 4%, we see that the annualized returns of S&P 500 decreases to 6.59%. One thing to note here is that these returns were achieved when the dividends were reinvested into the S&P 500. Now, because we want to exclude the effect of inflation, we will use the inflation adjusted 6.59% as our benchmark for the returns. However, because the past performance does not always predict the future performance, we will actually use a slightly lower estimate of 6% as our future expected rate of return. Now, based on the 6% adjusted inflation rate of return, I have already done the calculation for a range of investment amounts. And as you can see on your screen, that for $100,000 invested in S&P 500 by the age of 35 would turn into an inflation adjusted $500,000 by the age of 65. Similarly, if you invest $200,000 by the age of 35, then that would turn into inflation adjusted $1 million by the age of 65. And finally, if you invest $350,000 in S&P 500 by the age of 35, then that would turn into $2 million by the age of 65. In this approach, once you make the investment by the age of 35 and let the money compound over the next 30 years, then you will never have to worry about how you can afford your retirement. But the biggest question is, how can you save $350,000 by the age of 35? Now, the savings rate will vary for each person depending upon their income and expenses, as well as whether you have a single income household or a dual income household. But here is a very simplified plan that can help you plan your target of savings and investing $350,000. I have created a yearly savings plan starting from the age of 25 till the age of 35 that will help you plan and achieve this target of $350,000. As you can see on your screen, from the age of 26 to 28, you must target to save and invest $20,000 each year. Thereafter, for the next 3 years, from 29 to 31, you must target for $30,000 each year, and for the next 2 years, from 32 to 33, you must target $40,000 each year, and finally, from the age of 34 to 35, $60,000 each year should be your savings and investing target. This plan may not work out exactly for every person. However, it provides you a framework on how to plan your savings and investment from the age of 25 to 35. Now the final question, what is the best investment strategy? So because this is a long-term and passive investment, the most optimal strategy would be to dollar cost average in the low-cost S&P 500 ETF. This would be the most optimal strategy for most people because this does not require technical knowledge and emotional control to outperform the S&P 500. And secondly, more than 90% of the fund managers underperform the S&P 500 over the long term. So the odds of you outperforming most of the fund managers by dollar cost averaging in the S&P 500 ETF is higher than trying to outperform the S&P 500 by picking individual stocks and other investments. I hope this video helped you get one step closer to your financial dream, and for more such content, subscribe to my channel and hit the like button.